Okay, in this tutorial, I'll be showing you Apple stock. We'll be evaluating that. I'll just copy this and I'll paste it in Google. I'll type stock besides that. On the left hand side, I have information from Google, and on the right hand side, the information is from Wikipedia. Okay, so let's go. The last sale or the price of stock right now is 198 and it's in US dollar. So I'll just write 198 here. Okay, so if somebody wants to buy the stock now, so they will buy it for 198 US dollar. One stock they can buy, and it was born in 1976. Okay, founded, you can see from Wikipedia. The sector is technology, but I'll show you from where you get the sector later in the video. Okay, and now there are some ratios that are very important, just for first scan, because you can just go into as much detail as you want, but I'll just go through some things. I use Macrotrend website to see these ones, so I'll just go to macrotrends.net. You can just type in Google, and I'll go to price ratios, then I'll go to price book ratio, and I will just paste the stock I'm searching. You can just paste the symbol or the name. Click on that, and it will give you the price book ratio. And the price book ratio is 8.69 right now. So it means that somebody who buys the stock right now on 27th of June, if somebody buys Apple stock, they will be paying 8.69 times more than what the stock is really worth. So this stock is um, very expensive. It's 8.69 times more expensive than it should be. So it is more expensive than the book value. Okay, what the real price should be. But if I just have a look in 2018 December, it was 6.3 times more expensive, but now it's 8.69 times more expensive. If I look at 2016 June, it was 3.89 times more expensive. So somebody who bought the Apple stocks in 2016 June could have bought stocks more and cheaply, and it would be the same stock, but it would be quite cheap to buy. But right now, the same person will be paying 8 times the amount for to buy one stock. So the more the numbers are lower in price book ratio, the better the cheap stock you're buying. So the lowest I have is in 2008 December, which is 2.92. Somebody who bought stock at that time um, bought the stock very cheap. Um, they paid twice or nearly thrice, 3 times the amount, which is still expensive, but still it's cheaper than today. So it's very expensive to buy Apple stock right now. So they'll be paying 8 times more money. If I go to debt to equity ratio, I'll go to other ratios and debt equity ratios. Um, Debt to equity ratio should be zero point 0.5 or lower than that. This means that if it's 0.5 or lower than that, this means that it's less risky to invest in this stock. So it's more secure. There's margin of safety. If you look, it's 0.85. It means that it is risky to invest there because there is very little difference between the equity and long-term debt. Long-term debt is 90.2 B. B means billion, and equity is 105. So it's very close by. So it means that it's operating a lot on debt, as well as equity, but a lot on debt as well. So the lower the ratio, the better. The more the firm is operating on equity, the better. And if I just have a look, like here, until 2015, it's below zero point 0.5. After 2016, it's operating a lot on debt. It's above zero point 0.5. It's operating a lot on debt, and continuously the ratio is increasing. And now it's 0.85, which is nearly the highest ratio. So it's operating a lot on debt. So this is very important because you have less margin of safety, and it's not secure to invest in this kind of stock. Um, then if I see return on equity, which is very important because whatever shareholders have invested, what return they are getting. Return on equity should be 8% or above that. That's a good one. So if I look right now, it's 51%. And if I just go back, and it's like consistently above 8%, it's consistently above 8%. And yeah, it has been above 8% all the time. So which is very good because it has some ups and downs, you can see, but still it has been above 8%, which is very good consistently. So current ratio is very important because the assets should be more than the liabilities in a firm. And if it's 1.5 ratio, it's ideal. There's very less risk. The ratio is 1.32. It means that the assets are more than liabilities, but still it's not very secure because it should be at least 1.5 ratio to be secure, to have margin of safety. And you go back and it's 1.13, which makes it more risky. It should be at least 1, but still 1.13 is not a lot of margin. And so if I just go back, I can just see that the ratio has changed. So if you have a look, since 2014, it had a very good ratio. It was 1.5 or above that. Since 2016, sorry, 2014, the ratio has lowered from 1.5, and it's been lowering. Again, it goes up and down, but consistently it has been below 1.5 since 2014, which is not a good sign. It means that there might be, the liabilities are increasing and the assets are not increasing as much. So, after 2014, like 5 years now, it's been below 1.5, which is not very ideal. Okay, so let's have a look. It pays the dividend of 1.56, which means that 1.56, which means that any firm that pays dividend is, you can say that it's doing good, maybe because it has extra money to pay its shareholders. So it's generating enough money to pay its shareholders, so which is very brilliant. So you need to look if a firm is giving a dividend or not. Then the next thing is market cap. So how big is the firm? It's in billion, million, or whatever. That shows how big the firm is. Apple is in billions. Okay, so you can just have a look from here. It's straightforward. And then you can just have a look at the patents. So I use a website, Justia Patent, and I'll just type in, I'll just type in the exact Apple Inc. in case some other firm has the same name. So I'm just copying from here, and I'll just paste it here. I'll just search it, and I'm not focusing on inventor, I'm focusing on applicant because applicant is the one who has full rights of the patent. So it's in 2012 they have a patent, in 2012 again, November 13, 13 March, February. So you can just go through the patents, and what I'm looking at is if they have like previous patents, then it's good thing. But do they have recent patents or not? If they have recent patents like in 2017, 16, 18, 19, then it means it's still thriving and it's still trying to outwit its competition, and it's innovating, because that's more relevant. Because if it was innovating in 2013 or 12, if it had patents and not now, that's not a good sign. So you can just go through the list and see if it has recent patents, and it will give it a margin of safety, and it will patent acts as a moat. So it's very important for the firm because it gives the firm a competitive edge. And if I just go to Yahoo Finance, and I'll just show you one more thing. um, I'll just type in the company, okay, Apple, and profile. And I just want to show you, these are full-time employees, this is industry, and the sector I was talking about, technology, you can just see from Yahoo Finance, this is technology sector. And secondly, I'm just interested in key executive salary. So these are top key executives, and companies who show all the salaries of their executives, they are more transparent and you can trust them, you know. So I can just see that there are four executives that have shown their salary, but not the fifth one. So I need to search on that. So you need to know that if how many executives they have shown and what salaries they have. You can compare this with same sector companies and compare their salaries as well to see if there's a big difference and why there is. And um, I'll just show you one more thing. If you go to Apple Inc., I'll just type that, and Indeed reviews. Um, and so working at Apple, it tells you how people feel like from inside. So what employees feel like, because what employees feel, it shows on the company as well. So it's 4.2 stars, and there are 7.6K reviews, and you can see the cons and pros. And same, you can just type in Glassdoor, okay, and then see the reviews. And I'll see it's four, review is 4 star. So again, they have 15K reviews altogether, which is a lot of reviews. You can read through them, and it tells a lot about the company. So that's basic, that's like basic thing I have gone through with you. And